Hey, good morning. Hope you're doing well. Let's get right into rates. Interesting things happening. For the most part, we're right about where we were last week, fluttering around these numbers a little bit. This is no discount fee, no rate buy down on these. 30-year fixed, conventional conforming, right about 7% before you start buying the thing down with discount fee. FHA right where it was last week. VA a little higher for some reason. I don't know what's going on there. USDA right in the middle, 6.49. Now, sometimes it's worth it to buy a rate down, and sometimes it's not. I think it is on the 30-year fixed conventional conforming, especially if you can get the seller to do it. 1% of the loan amount added to closing costs will get you from about 7 to about 6.625%. It could be a lot of monthly savings. I look at it this way: you pay X amount to buy the rate down so that your payments lower. Well, you need to recoup the cost of buying it down via those lower monthly payments within 4 years max. I go about 40, 36 months. It'd be nice to do it in 3 years right now because of the probability that you're going to refinance before you recoup that money. So that's what I look at a lot of the time is how long does this take? Had some kids just now in a Zoom call where we would have taken 5 years to recoup the cost of the rate buy down that they wanted. Not the best idea unless you have a super strict budget or the seller's going to do it from a seller contribution. I'd keep that recoupment at about 36 to 40 months. FHA right here, not much movement with 1% added to closing costs. You already have the 1.75% FHA mortgage insurance rolled in. If you add a 1% discount fee to closing costs, the buyers are paying, that only gets you, whoopsie, that only gets you from like six and a quarter here with no discount down to six even. So, not advisable. I would not buy that rate down at all in that circumstance. VA, though, you get from 6.5 to 6, a nice half a point. It's a big chunk. You're going to recoup that more than likely, depending on the loan amount, in 36 months, something like that. I always do that. I work that math out and kind of show and teach buyers, especially first timers, what the effect is. Is it good or is it bad? What do I think? I show you no buy down, what I think is good, and then way too much. Then I do what I'm told. You know, makes my life easy. News. What's driving all this? Uh, Tariffs are not hurting mortgage rates. The talk about tariffs, it's a nice, sexy headline right now. Yeah, they are not hurting mortgage rates, partially because there are people who say that tariffs in and of themselves are not inflationary. Also, they're not sticking. He's threatening tariffs and he's having conversations, and we're starting to collaborate about the stuff that he wants to do, and then he's not putting tariffs on people. So it's a lot of talk, a lot of bark, not much bite. So it's not really happening, right? Uh, Point two, the Federal Reserve holds steady on rates last Friday. What that means is the Federal Reserve did not decrease the overnight Fed funds rate that drives a lot of the economy. That's a good thing, I think, because we have some work to do to hold inflation and hopefully reduce it. The last two times they decreased the Fed funds rate, mortgage rates went in the opposite direction. So we held steady, thanks in part to the Fed holding steady on rates. Number three is a big one here. The new Treasury Secretary Scott Bessent is going to take over and run the Consumer Finance Protection Bureau. CFPB was created after the big mortgage meltdown in 08-09 uh, to be a watchdog on the mortgage and financial industries. A lot of good, I think, paperwork came out of that, the loan estimate and closing disclosure, the time frames, the font size you have to have on those, what you have to show on one piece of paper. You used to have to go to 9 different pieces of paper to see what your rate was, what your payment was, are you escrowed, and all this other stuff. So they kind of consolidated some paperwork there, and it's been good. But what you don't realize is there's talk of dissolving the CFPB by people who don't know what they're talking about. If the Consumer Finance Protection Bureau were dissolved, the mortgage industry would immediately come to a complete halt because the CFPB makes sure that the guidelines associated with different mortgage types are adhered to. They put a rubber stamp on every mortgage loan that allows it to be sold. CFPB gets shut down like that, the whole industry, not the brakes, the power is gone. Everything stops. Nothing can be moved. Nothing can be sold until the CFPB is put back into some working order or is modified without being shut down. So I think Bessent is a decent enough guy. He seems to know and want better terms, better rates for everybody. Don't know how they're going to do it, but so far so good there. The jobs numbers are coming in this week. That means the JOLTS report, how many job openings are there? ADP employment report tomorrow, jobless claims and unemployment Thursday or Friday. Is it going to be kind of interesting? We keep seeing layoffs. Hopefully, we'll see uh, more jobless claims so that we get improved mortgage rates. I'm sorry, it's just the way it is. CPI next Wednesday, Consumer Price Index, PCE, personal consumption expenditures, end of the month. There's no Fed meeting this month. It's going to be March 19th. So remember, only one company can be number one in customer service. And I'm honestly very busy right now. And thank you so much. I will see you tomorrow. Have a great day as I find the stop button.